Disclaimer. This video is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. All opinions are based on research and publicly available information. Cryptocurrency investments are highly risky, and market conditions can change at any time. Always do your own research, DYOR, and consult a qualified financial advisor before making any investment decisions. Crypto Analysis is not responsible for any financial losses resulting from the use of this content. Thank you for watching and supporting Crypto Analysis.
Welcome back to The Explainer. Today, we're diving headfirst into an asset that's actively bridging the gap between traditional finance, or TradFi, and DeFi. We are unpacking Canton Coin, its underlying network, and the truly massive implications it has for the broader market. We're going to look straight at the data and the history to figure out if this token is an unstoppable institutional giant or just a highly centralized risk. Plus, we'll see why your traditional stock portfolio might actually soon feel its impact.
Okay, so what actually happens when Wall Street, the ultimate gatekeeper of traditional finance, decides to build a crypto network? I mean, for years, the narrative has always been that legacy banking and decentralized cryptocurrency are fundamental enemies, right? But what if the biggest banks in the world were actually secretly backing a massive crypto asset, designed entirely by and for them? Well, that staggering irony is exactly what we're looking at today.
Here is our game plan for today. We'll start with Wall Street's blockchain weapon, look at exactly how Canton Coin works, check out the push for adoption, ground ourselves in the current market reality, and finally wrap up by weighing the bull versus the bear case. Let's get right into it.
All right, Section 1. Wall Street's blockchain weapon. The paradox of institutional crypto.
So before we even touch the coin itself, we've got to talk about the engine running the whole shebang. This is the Canton Network. Built by Digital Asset Holdings, it's built as a privacy-focused network of networks. But here is the absolutely crucial takeaway. Unlike public blockchains like Ethereum or Bitcoin, which are built entirely for transparency and decentralization, Canton was designed from the ground up for one thing: compliance. It is specifically tailored to meet the rigorous regulatory demands of global banks and institutional finance.
Just look at the names in this founding consortium from May 2023. We are talking about absolute heavyweights here: Goldman Sachs, BNP Paribas, Microsoft, and Deloitte. Seeing these legacy players laying the foundation for a blockchain network perfectly highlights the wild paradox between the traditional financial world and the crypto space. They aren't just dipping their toes in the water, they are literally pouring the concrete.
Moving on to Section 2. Let's look at how Canton Coin actually works and how it fuels the network.
While the network itself was announced in 2023, its native utility token is actually a lot newer. Canton Coin, or CC, officially launched on July 25, 2024. You really have to think of Canton Coin not just as a currency, but as the actual engine grease making this massive machine run. It's the network's fuel. It directly pays for vital enterprise services like data throughput, messaging, and bandwidth. Honestly, without the coin, the network simply cannot function.
Now, Canton operates on a pretty unique model known as a burn and mint equilibrium. Here's how it works. First, network usage generates fees. Second, and this is where the magic happens, those Canton coins used to pay for the network fees are permanently burned. They are completely removed from circulation. Poof. Finally, step 3, new coins are minted to reward validators based on actual network usage. Basically, this creates an engine where sustained network usage creates real, measurable deflationary pressure.
Tracking the timeline here, the narrative is super clear. It was all about institutional adoption over retail hype throughout 2024 and 2025. After the May 2023 announcement and the July 2024 token launch, 2025 saw some very aggressive real-world testing. Major market players like Euroclear and the World Gold Council successfully completed pilots to tokenize assets like gold and Eurobonds right there on the network. Plus, Hydra X stepped up, becoming the first APAC custodian to support the token, perfectly bridging the gap to Asian markets. And then boom, fast forward to June 2026 and they marched straight to the SEC with a grayscale ETF filing.
And I really want to underscore what a massive potential catalyst that June 2026 grayscale ETF filing is. Just listen to this quote. If approved, it will allow traditional stock market investors to gain exposure to CeFi without having to custody the crypto themselves. That is huge. Just like we saw with the Bitcoin and Ethereum ETF approvals, this is a massive milestone. It essentially opens the floodgates for everyday retail and institutional capital to flow into the token without dealing with the friction of digital wallets.
Which brings us to Section 4, current market reality. Let's look at the actual numbers behind the narrative.
Looking specifically at the market capitalization, you can really grasp the sheer financial footprint of this project as of June 2026. The current price is sitting right around 15 to 16 cents. That's a bit down from its all-time high of 19.4 cents back on February 2nd, 2026. But the scale of the capital here is what's wild. We're looking at a market cap hovering between 5.2 and 6 billion US dollars, with a massive circulating supply of around 38.7 billion coins. That is a staggering amount of liquidity for a token that's primarily utilized by institutions.
So who's actually making money right now? Well, it totally depends on when you got in. For the profit view, investors who bought in during the early accumulation phases of late 2024 and 2025 are looking at some really solid gains, largely driven by those steady institutional rollouts and the recent ETF hype. But for the loss view, if you FOMO'd in at that February 2026 top, you're sitting at a minor loss of about 15 to 20%. And honestly, recent price action has been a bit subdued, mostly dragged down by broader crypto market sell-offs. Specifically, Bitcoin has been struggling at that $60,000 level, and as we know, when Bitcoin catches a cold, the rest of the altcoin market gets the flu.
Finally, Section 5, the bull versus bear case. Time to weigh the risk and the reward.
So, is Canton Coin actually a buy today? Let's put the best and worst case scenarios right head to head. On one side, we have the ultimate bull case, deflationary institutional usage paired with incoming ETF inflows. On the flip side, the ultimate bear case, extreme whale centralization paired with enterprise pivot risk. Like any crypto asset, Canton Coin comes with some amazing benefits, but also extremely high-risk caveats.
Starting with the bulls, the fundamentals here are undeniably strong. First, the institutional backing is completely unmatched. Canton is actively being integrated by some of the largest financial infrastructure providers in the world. We're talking the DTCC, BNY Mellon, and CBOE. This isn't some internet project relying on fleeting meme coin hype. Second, those burn mechanics we talked about, they mean sustained institutional usage permanently reduces circulating supply, which could naturally drive up the price. And finally, that grayscale ETF pipeline could literally funnel billions directly into the token from traditional markets.
But we absolutely have to talk about the bears. And frankly, this right here is the glaring red flag of the entire project. Notice the massive imbalance. 89% of the entire Canton Coin supply is controlled by just the top 100 wallets. Only 11% belongs to the rest of the world. The centralization risk here is honestly terrifying in scale. Think about it. If even a handful of these institutional whales decide to take profits and dump their holdings, the price of Canton Coin could crash catastrophically.
And it's not just the whales. There are two other major risks. First is enterprise pivot risk. Canton's entire value is tied to legacy financial institutions moving their operations on-chain. But what if those banks decide to just build their own competing private ledgers? If that happens, Canton Coin loses its primary utility basically overnight. Second is macro volatility. Despite its enterprise focus, at the end of the day, it is still a cryptocurrency. It remains highly sensitive to broader market conditions, inflation data, and, as we saw earlier, Bitcoin's mood swings.
Canton Coin bridges the gap between decentralized tech and traditional Wall Street finance better than almost anything else out there right now. It is a high-conviction, fundamentally strong project for sure, but that extreme whale concentration requires some very serious caution. Which leaves us with the ultimate question. As global banking firmly goes all in on tokenization, can Canton Coin's massive, undeniable utility actually outweigh the glaring, violent risks of its extreme centralization? It's a fascinating clash of two completely different financial worlds, and it's absolutely a space we will be keeping a very close eye on.
Thank you for watching this video. Please subscribe this channel.